let's talk about how to build a junior mining portfolio for this year. Okay, so the starting point that I wanted to start with, hopefully the rest of my presentation is not as redundant as that statement. My starting point is a reminder that metals are different from each other, and that seems obvious, but it is easy in junior mining to do one of two things, to sort of get excited about metals as a whole, or exploration, discovery, and sort of lump them all together as a concept, or to get excited about a particular metal because you dive into it, you see the fundamentals for it, and then not to put that excitement into context, not to put it in a time frame. And so I think it is important to remember that metals are individual, they move on their own time frames, and those time frames help you determine when they should go. This is just uranium, gold, and copper over the last 5 years. There's some correlation for sure, but there's also a lot of divergence, and that's just an example. And the reason that I bring this up is I do believe that you should always step back and think to yourself, okay, what individual metals do I believe in? What time frame do I think those metals will perform on? And do I have a thesis for why that's going to happen that I can evolve as data comes in? And if I have the answers to those two questions, then I should be able to formulate a portfolio that reflects that, and I should be able to have expectations for that portfolio that are more reasonable, that are more grounded in reality, right? So I'm just going to go through some of these metals, and I'm going to spend a bit more time with uranium than others because uranium's super fun. So uranium, obviously happening right now. Spot price has more than doubled in the last year. At the beginning of February, it jumped another 13%. Because Kazatomprom, I say cut guidance, really admitted that it was not going to meet guidance, which is something that those who follow uranium closely already knew. And the US took its next step in supporting nuclear, which happened to be pledging $500 million to build fuel processing capacity, because guess what? All of the fuel processing capacity is in the East and is becoming less accessible. That US commitment, like I say, is the latest in a series of very significant moves on the federal, but also on many state levels to support nuclear, and that's really, really important. Okay, so the Kazakhstan news was really important because Kazakhstan is 40% of the market, massive, massive component of the market, right? Their cutbacks in production in 2016, they did that to right the bear market, and it worked, along with others who also participated. It was a great move on the part of uranium producers. Their restarts, ramping back up to full capacity, were supposed to help fill the gap that the producers collectively created, but that's now been delayed by a couple years because of a lack of sulfuric acid availability. We can talk about that at length. I'm happy to talk about sulfuric acid and capital investment in Kazakhstan to anyone who's interested. The point is they're not going to be able to catch up quickly, and so the guidance that they wanted to be able to get to has been delayed. But the spot market is dry now. That's why the price is moving, right? The spot price is actually just an average of contracts that have been signed, have happened. Contracts are being signed at much higher prices because there just isn't availability in the spot market. But there's still a lot of need to restock. And in particular in America, there's a few interesting, one particular, quite large, long-term, like 14-year contract out for bid in the market right now, which is unusual. Usually, utilities who need uranium go and talk to their producer friends, and they sort of one-on-one come up with contracts. They don't usually put out bids for like 14-year contracts in the market. The fact that it's out there does two things. It signals that there's not a lot of availability, like producers aren't willing to just sign contracts. Their friends are saying, no, sorry, we can't do that. And it sort of makes it possible for other utilities to also come out and say, okay, you know what, we're also in dire need. Let's also put contracts out there. So even though the spot price has pulled back in the last few weeks, I can talk about that as well, the contract market is heating up, and that's really important because that's really fundamental support. To fill this gap, the spot market is dry, there's a big gap in production. To fill this gap is not easy. There is some new production coming online in the next year. That's what we would call the easy pounds. Those are largely restarts, taking advantage of existing infrastructure in America and adding some new well fields and whatnot to it, but it's the easy pounds. The hard pounds take longer. They are greenfields mines that still need to go through big permitting hurdles and financing hurdles. Those are going to take longer, and it's going to take years to bring those to market. So I'm comfortable to say that the uranium price is going to be higher at the end of this year, and it's going to stay high for quite some time because there's just no short-term answer to the supply gap that is very present right now. Yes, the price dipped in the last 2 weeks. That was largely one player or one trader who was playing what we call month-end games. Uranium traders often have these contracts that let them buy their uranium over the month at the final close price of the previous month. So they play games trying to push the price down at the end of the month so that then they can buy their uranium cheaper for the next month to sell it into. That's what was going on over the last 2 weeks. It was not a fundamental situation. Okay, for a metal that's moving right now, you can buy whatever you want. That's the fun thing about a market that's happening, right? You don't have to be delicate about it. You can buy whichever stocks in that market you like. Now, in the uranium world, there's only about 50 real uranium stocks out there. So like it's winnowed down. It's not such a massive pool to try and choose from like gold, let alone oil and gas. The other thing about it being such a small market, though, is that when investor interest turns to uranium, it's like Niagara Falls through a drinking straw, right? It's just really hard to jam all of that investor interest into just a small number of stocks. So because that Niagara Falls is trying to jam into a small number of stocks, they all do well. The best ones will always do the best. For this particular market, growing US production is the thing that has done best so far and will likely continue for some time to be the thing that does best because it is specifically US production, US Canadian, US friendly production that's needed. Advanced projects have also done really well, like NextGen is on here, but there's very few of these advanced projects out there. Explorers, interestingly, haven't moved that much yet. And I think that that's a very interesting opportunity for those of you who are inclined to play the uranium space. I think that explorers will have their moment this year. Again, happy to chat with people about that. Okay, moving on to other metals. Gold. Even a couple months ago when I was giving my talk in January, I was like, yes, rate cuts are coming. We're going to get a gold market. It's going to happen soon. And now I'm like, I mean, I don't think we're going to get rate cuts until late summer, fall, something like that. Which of course is for a good reason, which is that we are seeing economic strength out there, and so there's no need to cut rates to stimulate the economy. So macro-wise, it's a good thing, but it does delay, perhaps erase the reason for a gold-only bull market, that the gold-only bull market that we had been thinking was going to crop up early this year. We thought that we were going to start seeing more economic weakness, we were going to see rate cuts, and gold was going to just shine as a safe haven. That doesn't seem to be how it's playing out right now. Instead, we're seeing economic strength, we're seeing the FOMC members continue to push rate cuts back. That's a reality. At the end of the day, gold, the next leg up for gold will require either those rate cuts or economic strength that creates a broad metals bull market. Gold gets to play along when there's a broad metals bull market, even though it doesn't have the same drivers as the other metals in that situation of economic strength. It has totally different drivers, but it still gets to play. The circle that I've put down there on the chart on the bottom shows that gold, was that doubled from 2004 to 2008 while rates did that. They went really high. That is gold playing along in a robust commodities market. It's a commodity, even though it's an investment commodity, it still gets to be a commodity. It still gets to play along. And so if that's the situation that we end up in, all the better. I mean, that means we also get to play the base metals that we see big fundamental supply gaps in. So if that's the direction we're heading, great. But gold is going to have to show us, the economy is going to have to play its cards for us to know which kind of gold market we're going to get. If we start to see economic weakness, then we can see rate cuts coming. As soon as rate cuts come, then gold will go. Alternately, we might not get rate cuts, in which case we will see a broad metals bull market develop, and gold will play along in that market. So I think it's one or the other. It's not going to happen right now. If it's not going to happen right now, there's no need to deploy there's no need to deploy money broadly across the gold spectrum. You can absolutely, I'm going to talk about explorers at the end of the presentation. They are their own category, right? They move to their own beat, that's discovery. But you don't have to deeply deploy across the gold spectrum if you don't expect gold to be moving right now. I like to own some of the stocks that move first and most when investors turn their attention to gold. So, I mean, producers who are just ridiculously undervalued using whatever historic metric you want to crunch, or those who are building or close to building big new mines, just not a lot of them out there. These are the stocks that will move the most when investor interest turns to gold. And then you have your other gold stocks that you like ready. When the market comes, you come to it with that list. Like I say, I'll talk about explorers in a moment because they're a different thing. Okay, copper. Yes, there is a massive supply gap coming for copper. Is it here right now? No. Uranium is moving because the supply gap is here. Utilities that need uranium are having trouble finding uranium today. Like, the supply gap is here. It took like 6 years of working through the excess in the uranium market to get to the point where utilities couldn't just pick up pounds whenever they wanted. We are in the working through the excess part of the copper market and the silver market right now. There's above ground stocks. And remember a couple years ago, everyone was talking about warehouses full of copper in China that were being leveraged multiple times to play the housing market. Seems like an age ago, but it wasn't actually that long ago. And those are the kinds of stockpiles that are bridging the gap right now. Yes, copper is in slight deficit. Yes, there are these stockpiles that we are working through. We're in the churn part of the process right now. We will churn through, and when we do, there aren't enough mines. I think there's 3 reasons. I like to summarize it with I like to distill it down to 3 reasons as to why we don't have enough copper mines built and coming to the fore. Conservative executives, after the excesses of the last bull market, management teams at mining companies became specifically conservative. And so they focused on dividends, and they focused on share buybacks, and they focused on cash flow, which absolutely has its benefits, but they did not focus on building new mines. Disinterested markets. The markets weren't saying, we love metals, go and build more mines. That's not the message that executives were getting from the market, so that amplified that conservatism. And then ever harder permitting, right? You really have to push to permit a mine, and if you're not really into it because you're being conservative, then you're just not going to make a lot of progress. So those 3 factors mean that miners just have not built enough new mines in the last decade, and of course discovery and development rates are just way down. This is a quote from someone who did a big summary of copper projects that are out there right now. Of the top 40 in the world, 31 are facing significant challenges. If you limit that list to projects that could produce within the next 10 years, so they're at least at a pre-feasibility stage, it brings it down to only 23 projects, 9 of which are fully blocked, and 5 of which have major permitting risks. So more than half of the projects that are out there that could produce in the next 10 years are either not making progress or at significant risk of not making progress. So it's really tight out there. The copper project cupboard is very bare. So I say copper, yes, because this gap is very real, and it has been establishing itself for like almost the last decade, but we're still churning through the excess right now, which is why it's not going to happen right now. Investors buy commodities like, in particular, the PhD of metals, copper, when they are positioning for global growth. I think that we are getting there. I think that there's getting to be, especially in North America, a sense that it's time to position for global growth. But I mean, it was only 6 months ago, certainly 8 months ago, that recession risk was the topic du jour. That's the only thing everybody was talking about. When people are stressing about whether there's a recession coming, they're not positioning for global growth. Those are absolutely different things. We're making that transition. It seems like we're heading towards the growth side of the spectrum. There's lots of questions out there still. That's why it takes so long for this freighter to turn around. We have to answer all of those questions and see data month after month after month. But we need to either get to the point where investors are positioning for global growth, for which they buy copper, or we actually run out of copper, which is what happened with uranium. And so we're not quite there yet on either front. So copper is going to happen, but it's not here yet. Silver, similar arguments to copper. There's definitely silver experts out in this who will take this podium over the next 2 days who can talk about this in much more detail than I, so I will not spend a lot of time here. But it's the same concept. And the silver market isn't really going to run, in my estimation, until investors are positioning for growth, because silver is such an industrial commodity, or they actually run out of silver that they can accessibly buy. Lithium is sort of like, as a new commodity with ramping demand. Its reactions have been outsized over the last few years. I mean, the price chart that's on the top there shows that. You know, EV sales booming in 2021 and 2022 sent the lithium price up 700%, which is just a ridiculous number. And then in 2023, guess what? China's like, we're not going to renew those subsidies. And US interest rates rose, so the car demand fell off there, and lithium gave back almost all of those gains. So slam back to the bottom. But what's really interesting is that that Chinese EV sales are still at all-time highs, and US subsidies for electric vehicles remain very real. So the argument still remains. In addition, US subsidies only apply, as we all are well aware, supposedly if it is not Chinese lithium. If the US were going to reach this admittedly entirely impossible target of getting EVs to be 50% of the market in the next 6 years, like I say, it's not going to happen, but that's the official target, then, you know, friendly lithium, domestic lithium or friendly lithium production would have to increase 40-fold. Insane numbers, but it gives you a sense of the amounts that are needed in the context of that political framework, which is unrealistic. But there are shades of uranium in that lithium moment. I don't really need to do this. I've already said this. When we get to global growth, these commodities will go. There isn't enough production, and demand will soar, and investors will get interested. That's a really important missing link, is the investor interest link. And when that happens, you just start with producers, those with scale or margin, and then you go to the big advanced assets. These are just examples of Freeport and BHP to remind us what even the biggest copper miners can do when we get to a bull market for growth, right? Okay, I said I would talk about explorers. There's all of this, using timing for macroeconomics and patterns and which stocks move first. And then there's exploration companies, right, who march to completely their own beat, because discoveries work in any market. A really good discovery doesn't matter what's happening to the gold price, the copper price, the uranium price. It works in any market. So that's the game that I'm focusing on while I wait, right? While I wait for either rate cuts in a gold market or investors to start focusing on positioning for growth and then getting a broad metals bull market. In the meantime, I can play discoveries because, like I say, they will work no matter what's happening. These are some of the tactics that I like to keep in mind for my portfolio as a whole when I'm choosing explorers. You got to own a bunch because odds of success are actually quite low, especially on any individual test. Maybe this drill program doesn't work, this one is a technical success, and the third drill program works. It just takes time, and you need to be able to have patience or, you know, recognize when a target didn't work. You need to own quite a few. If you can buy in financings with warrants, that's great when it works, because then you can add to your position at close to that financing price. Do be aware, if you're a large player of low trading volumes, it can be hard to leak out a large position because these are thinly traded stocks. Of course, if a discovery happens, that consideration goes out the window because all of a sudden the trading volume goes through the roof. And that's what happens if we get that discovery. I do counsel, and I certainly do, take some profits if there's a price spike on discovery. The price could continue to go higher, but oftentimes there's like real excitement right around the time of discovery, and then it corrects. And then maybe it goes higher again, or maybe it keeps coming down. But if there's a really big price spike, consider taking some money off the table. In these markets, it's rare to regret selling when you see a big gain in some of your stocks. And I'm not saying sell all, just sell some so that you can feel good about having capitalized on that moment, lowered your cost base, and then you can continue with whatever the ride becomes. So broadly speaking, for each stock that you own, know why you hold it. Is it for leverage to metal price gains? Is it a takeout target? Is it because it's going towards production and it's a golden runway? Is it a scale growth? Is it discovery growth? Is there an exploration catalyst? For each stock in your portfolio, make sure you know the reason. Have a concise investment thesis for that stock in your portfolio, and then make sure that that thesis fits within that sort of timeline and metals thesis that you also have to develop for your portfolio to hopefully play out in realistic ways in this crazy economic situation. That's what I have to say today. These are the products that I create. I write a Maven letter, and I do a premium service for investors who are interested in financings.